All right, everyone. Welcome once again to the Faces of Business. I'm your host, Damon Pistolka, and I am so excited for our guest today because we have Patrick Donohue here from Hill Capital, and we're going to be talking about propelling your company's value to new heights. Patrick, thanks for being here today.
Thank you, Damon. It's awesome to be here and share insights on building value for entrepreneurs.
Yeah, it's awesome. It's awesome, man. We got introduced and I was like, wow, I have to have Patrick on because value is something we talk about a lot, on the show, talk a lot about in our work and with just in general with people. So
exactly. Well, I've listened to a number of your shows and so forth, and you do a huge service to entrepreneurs. So first off, thank you. And I know people touch upon what it takes to build value in a number of different ways throughout your shows. So happy we can dive in today.
Yeah, it's going to be awesome. It's going to be awesome. So Patrick, we always like to start out by letting the guest tell us kind of how they got into doing what they're doing today.
Yeah. So I have an entrepreneurial background, but ironically, I probably couldn't articulate that up until about 10 or 15 years ago. But I started as an entrepreneur, and I just actually was looking at this and thinking about that. But I actually still keep my picture of selling lemonade when I was 4 years old with my cousin Chad. And so, as they say, that's where it started. And I went on to love figuring out what things are valued, why they're valued. So I bought 10 shares of Coca-Cola when I was 10 years old. And it kind of set me on this path of collecting baseball cards and doing the typical things kids do. And that's really propelled me into my career in finance. I've always really find fascinating why things are valued the way they are.
Yeah. Yeah. So what spurred you to buy Coca-Cola at 10 years old?
Oh, this is a good story, Damon. This is fun. This is a fun one to start with. So I had older brothers and sisters, and as a kid, I had noticed that my dad gave them money for Christmas, and my dad was the very typical, like very conservative. Like we were one of the last families to have a DVD, or not even a DVD, a VHS player.
Yeah.
And so, of course, as a kid, I wanted a Nintendo or a Sega gaming system. Actually, it was an Atari back then. Sorry, I even stepped back. An Atari. And so that's what I was asking for Christmas. Well, the year before I hadn't got one. So I was wise enough at 10 years old to say, hey, how about you just give me money for Christmas so that I could go buy my own gaming system? And that my dad probably wisely said, no, I will not give you cash, but I will help you understand what these things are called stocks. And we'll work together to buy some of your first shares of stock. And so that's how it all started. So as a young person, of course, what do? You drink Coca-Cola and you're like, can I own this? And so that's where it started. And that's why I sat down with my dad and learned about stocks and bought my 10 shares of Coca-Cola as a young person.
Yeah. Yeah. 10 shares. That's awesome. That's awesome. So growing up then, did you know that you wanted to be in finance all the time, or kind of what's your path? How did it go?
Well, I always thought I wanted to be an attorney because my father was an attorney, but unfortunately he did pass away a few days after I turned 13. And so I kind of, as I started to explore law, I realized law was not what the show LA Law was all about. It was a lot of reading and doing a lot of things that weren't so fun. Yeah. And so that's actually when I started to think about like, oh, I could, be a stockbroker. That was kind of the term back then. I mean, today it's people are wealth advisors and so forth. But that's when I went off to college at Creighton University, what kind of put me on the path to study finance and took me to where I am today. We're sure going down memory lane. This is good, Damon.
Yeah. Well, I'll tell you, there's one thing. If people haven't, Creighton is cool because is that in Omaha or right outside Omaha?
Yeah, it's right outside Omaha, just straight south of where you grew up and went to school.
Yeah, yeah. And last time I was in Omaha, I was there for the College World Series. What an experience!
Yes,
what an experience! My goodness. I digress a little though, because that's and just it was such a good experience for me, and I encourage anyone if you're a baseball fan, college baseball, that is a great time.
Right. Well, I know you coach Little League, and
Yeah,
and so that's an awfully special place in the hearts of a lot of Little League baseball coaches and baseball players is the College World Series in Omaha. It's really second to none. So
yeah,
pretty
yeah.
neat.
It is. It's a cool place. So growing up in finance then, or growing up and going to college for finance, what out of school then kind of how did you progress into doing what you're doing today?
Sure. Well, out of college, I went to work for a firm that would today be called a fintech. We didn't use that term back then, but I helped start one of the first online brokerage platforms. Having gone to school in Omaha, we would see Joe, the founder of Ameritrade, would come in and talk in our classes all the time. And so I always found that fascinating. So I had the opportunity to help start an online brokerage firm in my early days and kind of be an entrepreneur. I mean, I was hired as an employee, but the brokerage firm was building an online brokerage platform. And so that was a heck of a lot of fun.
Wow.
But that was a bit of a flash in the pan because E-Trade and Ameritrade and others were really the 800-pound gorillas
Yeah.
and hard to compete with. But then I ended up going to a firm and writing research on public companies. So sell side analysts writing research on public companies. And that was a lot of fun. And so that's what really kind of took me into ultimately investment banking and doing IPOs, capital formation, advisory, valuation work for a lot of public and private companies.
Yeah. Yeah. Now in Hill Capital today, what are you guys doing with Hill Capital? What are you guys typically doing there?
Sure. Hill Capital Corporation is an investment fund. We are investing in primarily entrepreneurial-led businesses where the founder is still the CEO. And we invest $500,000 to $1 million in that business. And then we also have a community of which is around 56 ambassadors today who are advisors to us in our portfolio companies.
Wow.
To help those businesses grow. We're currently investing out of Fund 2, which is a $25 million investment fund. And to date, we have 12 portfolio companies and have made 15 investments. So we've done some follow-on investment work as well. And so that is my bread and butter. That's what I do day in and day out is meet with entrepreneurs and get to know their businesses and ultimately, find a couple that are a good fit for both of us and invest in and help those businesses grow.
Yeah. Yeah. So what are you seeing as some of the cool things that these entrepreneurs are bringing to the world?
Well, what's really fun about our portfolio at Hill Capital Corporation is that we have a diverse portfolio. We invest in a number of different types of businesses. We don't go to market saying we're an industry expert in any one thing. So we've invested in companies like Foreverance that makes custom ceramic urns. And they got national news. They've got national news a number of times, but big news when they made the custom urn for Prince's family when he passed away. They replicated Paisley Park as an urn, which is on display today at Paisley Park
Wow.
that for Prince. And so they've done a number of celebrities and a number of cars for car enthusiasts and dogs for dog enthusiasts. And so that's a very unique company. And Pete Sari and his team are very unique entrepreneurs that are building this business. So stuff like that we've invested in that, a little easier to understand. And then we've also invested in companies like Cytotherics that is producing human liver cells. And it's a biotechnology out of Rochester, Minnesota. The Mayo Clinic and other large investors are investors in Cytotherics as well. But they are producing human liver cells, and their work can literally save lives because liver is one of the last organs that it's pretty much lights out when somebody has an issue with the liver. And so their work is very fundamental to being able to do drug discovery and a number of other things that the liver is critical for. And so that's been a really fun investment as well to see them to build and grow. So
yeah. Well, and like you said, it is a real matchmaking kind of experience for you to find the right investments. So you talk
Yeah.
to a lot of companies, and there are a lot that for whatever reason don't really fit. So
Yeah.
let's talk about that a little bit,
Mhm.
because that's one of the things that I think a lot of entrepreneurs, especially startup entrepreneurs, really don't understand what you as that kind of investor coming in really is looking for. So
Yes.
and I know it's frustrating with them. And it takes a lot of time for you to educate people like this. So what point are you actually are starting an investment? Is it pre-revenue usually? Is it they've got some revenue, or where are you usually looking to invest?
Well, our fund at Hill Capital Corporation is a bit unique. We are not doing traditional angel or venture capital investing.
Okay.
We're investing in more Main Street type of businesses, like I mentioned, Foreverance. And another company is like Mercury Mosaics that makes handmade custom tile. And so I share all that as background because the type of businesses that we're investing in, Damon, typically have a couple million in revenue when we invest, and they're looking to grow to 10 million in revenue and
Okay.
20 million in revenue. They're
Good.
not necessarily gunning for 100 million or $1 billion. Now, some like Cytotherics are on that path and could be, but most of our portfolio are companies like Mercury Mosaics that are looking to really take the next step to just simply double and triple revenue in the years to come. And we're able to do that, Damon, because we have a bit of a unique structure to how we make our investments. We invest in businesses where we put $1 in and we look to get $2 to $3 back. And the reason why that's really important is because we're investing in businesses that are typically at an inflection point where they've got products and services in the marketplace and they're achieving profitability. So we set it up where we can get paid back over time. So we don't have to wait for an exit of that business someday, because that's the challenge with a lot of the traditional angel and venture capital models where they really need that entrepreneur to sell the business for cash in 5 years after they make their investment. And that's where you see challenges happen for entrepreneurs that don't really fully understand and appreciate what they've signed up for. So to your question, I really encourage entrepreneurs to get to understand and ask the types of questions that you are in getting to know who their potential investors are, to make sure there's an alignment of what that capital looks like, to make sure it's synced up.
Yeah, and that's why I was asking some of the questions, because I know if someone's listening here today, that is looking for this kind of thing, just you just don't know what to ask. If you haven't
Yeah,
been through the process a bunch, you just don't know what to ask. And one of the things, like you said, is what is the exit timeline for your investment, or what do you want your investment to do? And the
yeah,
way that you structure the payback, that's real important too, of your investment, to make sure that that works for you.
right.
All that's critical when you're an entrepreneur trying to find an investor, and when you're an investor trying to find the right company.
Exactly. And that was actually a big part of why I wrote the book Breakout Valuation, because in the book I talk about and encourage entrepreneurs to ask those types of questions, and including questions like, where does their money come from and what ties do they have and hooks back to their LPs and their investors, because that can often dictate the type of terms that the investor can make. So I could tell many stories around that, but it's very, very important for entrepreneurs to do as much due diligence on their investors as their investors are going to do on them.
Yeah. Yeah. Uh, yeah, we go down a slippery slope of challenging situations there.
Yes.
So when people come to you and looking for investment, what's the most common thing that says, we just can't do it?
Well, what we're really underwriting for is the people. And so we really lean into getting to know the founders and the majority owners of the business, because when we invest, we become business partners. And so we really want to get to know them. So a lot of times that's what we're looking for. So we start with the people. So we do background checks and all that type of stuff. But if they have anything that's not, aligned with our values, and our values are right posted on our website, but if they don't have things that's aligned, that's going to be a quick pass. And then obviously we're getting into the economic engine, the economic model of the business. And the economic engine has to make sense. We have to see where we can put $1 in, and that business can really generate, $5 to $10 worth of economics internally in that business in the form of profits and, more importantly, free cash flow. And so that all has to really to line up. And then it would take us into doing some due diligence, of course, into the industry, so on and so forth. So we look at it differently, than a lot of venture capital firms and VCs, where they're looking at like, can this be the next $1 billion thing? Can this be a massive home run? And they're starting with, how big is the market? At the end of the day, we're not getting too hung up on, how big is the market. It's more, can this entrepreneur really execute and double and triple revenues over the next 5 years?
Yeah, that's a distinct difference, because what you're doing is you're making sure that the profitability of the business as you expand it will give you the return, rather than a lot of investors invest for the exit to give them the return they need.
Exactly. And so what we talk about, Damon, is we want the entrepreneurs, the founders of our portfolio companies, to have optionality. That's key. So our investment enables optionality, meaning if they want to raise additional capital because things are going well and they want to continue to build, they can do that. If they want to continue to build and run a lifestyle business, they can do that. If they want to hand it over to the next generation and keep running this business for 50 years, they can do that. If they want to sell their business, they can do that. That's the big difference. And that's where, unfortunately, I'm seeing a lot of entrepreneurs get hurt because they're forced into exiting and selling their business when they may not really have wanted to, but they had no other way to provide liquidity to some of those external capital sources that provided them capital in the early days.
Yeah. We got a question here from Muhammad. He says, what's the name of your book?
Oh, sure. It is Breakout Valuation. And so that's simple, Breakout Valuation, and people can learn more at breakoutvaluation.com. And it's available anywhere you buy books. So
awesome. Well, thanks for that. Well, this is interesting. Well, we're talking about propelling your company's value to new heights, because you do talk a lot about valuation. You've done a lot of valuations on companies. So, and I don't even know. I'm getting confused here because I'm so excited. We have valuation is such an interesting thing for me to talk with professionals that do it every day and business owners, because there's such a gap in knowledge of what really is value, what drives value. So let's just start there. What do you think that entrepreneurs should be thinking about if they really want to propel their company's value?
If they really want to propel their company's value, they need to think about and be able to articulate the vision of where that business is going to go. So I talk about 19 drivers of real value in the book, but at the end of the day, to your question, the thing where people get value for the business is based on the magnetic vision. And the reason I use the qualifier magnetic is because it's one thing to have a vision, but you have to communicate it and articulate it in a way that attracts people to the vision. And if you look back at all the big companies and all that type of stuff, we can tell a story about how that founder had a magnetic vision. Jeff Bezos, Bill Gates, on down the line. And we don't even have to talk about the big companies. I could talk about that with Mercury Mosaics and as a custom tile manufacturer, and others that are really good at being able to articulate why their business should exist. But more important to that is where their business lives and thrives in the world in the next 10 to 20 years. That's where the magic happens. And that's where people get paid a breakout valuation.
Yeah. It is interesting because you get kind of caught in business valuation. We're doing them all the time. You're in it at a different level and different point in their business lives, but you get so tied up in the numbers, right? Because
yes,
it's a big part of it. But if there's the vision and the company is on that path, there is no doubt that that vision derives value.
Exactly. In Damon, I grew up in the weeds. You know, my whole background is in finance, and I have the chartered financial analyst designation, and I've done fairness opinions for public companies. And so I'm a student of the numbers. And so I always thought about companies in terms of like multiples and discounted cash flows. But a few years ago, actually, now I'm thinking about this, I was on the manufacturing floor of Mercury Mosaics, looking at these beautiful custom handmade tile that artisans literally, they're baking the clay there and glazing it by hand. And it occurred to me, I'm like, oh my gosh, that's what's creating value in that business. This business isn't a multiple of EBITDA or cash flow or whatever multiple you want to talk about. A multiple is a correlation. The causation is the people, the process, the vision, all these things that go into creating value in that business. And that's where the aha moment came. That was the inspiration behind the book Breakout Valuation.
Yeah. So talk about that a little bit more, because I think, you know, most people think that, well, the value is a multiple of the profitability. That's just the way it is.
So what happens is the multiples of correlation, that happens just to be the number that the number that comes out after the calculations of when the transaction is done and accounted for. A business sells for 10 million, had $1 million of EBITDA, and they say, okay, it was a 10 times EBITDA business for sale. Well, that's just factual. That is what it is. But that's not what caused the value. That's not what caused it, right?
Yeah.
That owner was buying that business thinking that they could take that 1 million in EBITDA and grow it to 2, 3, 10 million someday. And so they were willing to pay 10 million at that point in time. Now, if that vision wasn't there, or that ability to grow it from 1 million to 3 to 10, maybe it was only could grow it to 1 million or 2 million or 3 million over 20 years, then they probably would have paid 3 million. It would have been a 3 times multiple on that business. So that is what has been really lost in translation, unfortunately, where people have become, do I dare say, intellectually lazy when they overly talk about multiples, because we can look at multiples of all the things that have been done, and that's a bit of mind candy. But the real conversation is what caused the company to be purchased at that price. And that's where it gets interesting, because at the end of the day, the buyer of that asset is thinking about what that asset can do for them over the next 5, 10, 20 years. And that's why you see companies like Google paying $1 billion for YouTube back in the day. And everybody thought it was nuts because YouTube had next to no revenue, had no monetization plan, so on and so forth. And now buying YouTube for $1 billion looks like the biggest bargain that has ever happened in the history of finance. And so that's the difference, because the founders of YouTube were able to articulate, and Google and the executives of Google knew what that asset could do over time within their ecosystem. And they paid the founders that premium for YouTube back in the day because they understood what that business could mean to them.
Yeah.
That's the difference.
Yep. Yep, it is. You're right. And that happens, as you said.
Yep.
The multiple is just is an after. It is calculated after the businesses are sold, but to get to it, yes, it makes a difference in maybe starting, but when you really get into the details, it can change an awful lot from there.
Right. And you've seen it many times, I'm sure, in your business practice, where you'll have more, call it Main Street businesses and so on and so forth. Like I think about coffee roasters, because we've looked at a number of coffee companies over the time and so forth. And you know, you could look up on Biz Buy Sell and these other things where it's like the average coffee company is sold for 2.3 times seller discretionary earnings. Okay, whatever all that means. And you'll see some that, you know, sold for 2, and you'll see some that sold for 4 or 10 or whatever the case may be, and it's all over. But the numbers that are reported are an average or whatever the case may be. Now, there's a difference for those who bought into and believed in the Starbucks story versus the Sioux Falls coffee company that's only located in Sioux Falls and has one location and has a name that doesn't make sense outside of their geographic location. right? So that's the difference of why these valuations happen in the marketplace.
Yeah. Yeah. That's awesome. So beyond articulating the vision, what are some of the things that when you're looking at companies, you go, wow, that is a huge thing that we're going to be able to help realize? I mean, because you just see these things, you go, wow, there's something there that the owners may not see, or maybe they see a little bit that you guys look at it together and go, okay, now this is really something.
Well, I think what's interesting for us is that many times we're having that conversation throughout the underwriting process, and where they've got opportunities to expand their business. So when we first invested in Foreverance, they had like little to no sales around just like urns for pets, and now it's a whole category on their website, and people are buying $2,500 custom urns for their golden retrievers and so forth. And so we have those conversations through underwriting, and that's really interesting. But for us, a lot of times on the front end, we do want people to focus and not go too overboard or too quick into expanding into new product lines. So my long-winded answer to your question is, a lot of times it's a little nuances of being able to think about and help them on the little things in their businesses that can go a long way. So for example, a lot of companies spend quite a bit of money on pay-per-click or social or SEM and so forth. And so when they're thinking about like marketing on search engines, we're thinking about like some of our ambassadors that have quite a bit of experience, engaging on social media and being able to deploy strategies where they can essentially lower the customer acquisition cost for those types of companies, so they don't have to keep feeding the Google machine and being over reliant upon that. And that's where it gets interesting for us, because when you see those types of things happen and an entrepreneur be able to optimize and to dial in what they're doing and why they're doing it, that's what gets us pretty excited. Because maybe I'm just getting too old or something, Damon, but I've seen too many companies go belly up chasing the next big thing.
Yeah.
So we get really excited when they chase the thing that's like right in front of them and perfect the thing that's right in front of them.
Yeah. Yeah. Well, that's the entrepreneurial curse in a lot of cases, is that there's something that's really close to what you're doing that might be the big thing rather than the shiny object over in the other field.
Yes.
And, yeah. So as you're doing this and you're talking with people, you're out there, just talking with these companies, what are some of the companies that you have run across that you go, I would have never thought in a million years of this kind of company?
Yeah, it's a great question. So we invested in a company called Beam Healthcare that's out of Madison, Wisconsin, that provides telemedicine services. And what was really interesting on that is that their angle is that they provide specialist services. So you think about like when you go to a doctor, go into a hospital setting, you think about like if you need something around like cardiac or neurological, like you need to go into a very specialized facility and have that direct relationship. In Beam Healthcare, and now through their TeamSbyBeam, which anybody can purchase and basically get telemedicine access, but it's on the specialists. It's not just about like a general doctor. They can get access to specialists, and that is really cool. And of course, that was really fueled through the pandemic, when the regulators and everybody else had a lot of realizations where they needed to open up better access to healthcare for everyone. But that's been really fun to see Dr. Surju Patel accelerate his business plan around TeamSbyBeam and giving more people access to high quality healthcare, no matter where they're located. And so that one has felt really, really good.
That is cool. That is cool. And it's a great example of some of these, like you said, things had to change during COVID, but they've really changed some things and pushed us in new directions that helps a lot of people.
Yes, very much so.
Yeah, because you might not have a specialist within 200 miles of where you live if you're in the middle of Montana, or Alaska or something like that, but being able to talk to somebody over video and they can see all the test results, you can get the same kind of care or really close.
Exactly right. Yeah, and it's wonderful to see. I mean, he's got a number of stories of people that who knows what it would have happened,
Yeah.
if they hadn't, dialed into TeamSbyBeam, and it's really really neat to see. So,
Yeah. Yeah. So as you're so we've just come out, or not come out of, we've just rolled into a time when we had an interest rate adjustment. And
yes.
and I don't know about you, but I think that we lived in an artificially low interest rate world for far too many, well, a long time. I don't care if it's too many or whatever, but how has that really changed things?
Well, one thing for us is our deal flow went through the roof in the third and fourth quarter last year. And so a lot of venture capital started to sit on the sidelines. Banks, of course, clammed up, and we saw a lot of deal flow coming. And we had a number of companies, including a company that was well over 30 million in revenue, much larger than we would have ever imagined making an investment in. But they came to us because they have a banking relationship with one of the biggest banks in the United States, but they started tightening up lines of credit, and and their business was going well. They had an opportunity to expand in new markets, and they didn't want to slow down on that. And so we were able to make an investment there. And so that's where we've seen probably the biggest impact with the with the increase of interest rates. Is just more people looking for money, and it just has really solidified what I talk about in the book and what I always advise entrepreneurs on. I know you've talked about it a number of times on your podcast, like recently with Don, the fractional CFO person, but getting a line of credit when you don't need it and getting relationships when you don't really need them, super important. I know you and Don talked a lot about that, but that is really important to have and build those relationships, because now we are in an environment where the interest rates tighten, and it has a lot of cascading effects that happen really, really quick that decrease access to capital.
Yeah. Yeah, that's for sure. That's for sure. And I can imagine that is because the lines of credit, the sizes were definitely cut back, and
Definitely.
also the sheer amount of interest amount of interest that you pay reduce the amount that how far your cash flow will go as well.
Right. That's why I do think of it as a cascading effect. It does compound, unfortunately, when these things happen.
Yeah. So what are you excited about looking forward into 2024?
What we're really excited about looking forward to in 2024 is really more understanding of capital that is available for entrepreneurs. I've been a student of and a big fan of some of these other models like revenue-based financing and some of the early fintechs and so forth. And they do come and they go, and it does change and so forth. But there has been updates and new models to how people think about venture capital. And so we continue to see glimmers of hope that there's going to be a better and broader understanding among small business owners and entrepreneurs about what type of capital is available to them, because we still live in an environment where people either think about like they can get money from a bank or they can go on Shark Tank. And the reality is like those options aren't really a good fit for a lot of our Main Street small businesses, and they need to understand some of these other forms of capital and how they can structure things to be able to build and to grow. So I am excited about some of the other models out there, people that have been blogging and posting and hosting conferences around some of these other forms of capital. And I do think that our economy is going to continue to have spots that are doing well and are hot, like AI and the technology that supports it, like Microsoft and NVIDIA. They're going to continue to do well. We invest in a portfolio company, WareCorp, that has done very well because they build out technology solutions. They're an NVIDIA partner. So that's going to continue to be hot and do well. But some of the companies that are in capital intensive businesses, like we talked about, that are reliant upon, bank lines of credit and financing inventory, it's going to continue to be choppy waters. And then, probably stating the obvious, it's going to continue to be choppy with real estate and commercial real estate in particular. So
Yeah.
these things come and they go, but at the end of the day, entrepreneurs always have access to capital if they've got the right business plan and they've got the right things in place. And so we're excited about that. We always love working with entrepreneurs.
Yeah. Yeah. So you talked about other forms of capital, and I don't want to digress too far off that,
Sure.
but you know, when most business owners look at it, they think it is literally a bank or go out and find an investor. So let's just highlight a few of those that maybe an entrepreneur should know about.
Sure. So I talk about this heavily in the book, and I would point people to the couple of chapters that kind of go into the details about various types and forms of capital, because that can help entrepreneurs not only save a lot of money, but it can help build a much more valuable business and make sure more money gets left in their pockets. In the book, and what I share is that I would encourage all entrepreneurs to get to know like their local economic developer. So a lot of cities, municipalities have an economic development person or a group. Even big companies like the local power company usually has somebody that's in charge of economic development. I would encourage them to look and to tap into that, because oftentimes they know where these pools of capital are that a lot of other people don't, and it can be sometimes cheap or even sometimes free, because it can be grant money or various tax-based incentives. I know that a lot of entrepreneurs fail in looking for that and miss those golden opportunities. Grant money and things with the Department of Defense, so on and so forth. There's a lot of money there. But there are a lot of new opportunities and funds that are coming out there. The reason I hesitate there is because, unfortunately, for every good one, there's probably 3 or 4 bad actors. And you're laughing, you've seen this, and I've seen it, unfortunately. I mean, we have seen a lot of these fintechs that have really taken advantage of entrepreneurs, where it's the new cool online lenders. And we've seen it where somebody went and got a loan from one of these online lenders, and their all-in interest rate or their cost of capital was annualized at 87%.
Oh my!
Because the stated interest rate was something reasonable, it's still high, but something in the teens. But then when they piled on all the fees and so on and so forth, when you did the math on what it actually cost them, it was mind-blowing. And that's a problem. We saw a company that was doing a couple million in revenue that basically went out of business because of what had started as a couple $100,000 loan from one of these online lender players. And then, so I caution people to really, be aware of that type of stuff. And be a little wary. We also have a company that we're looking to invest right now that went with one of these online lenders that help them facilitate an SBA loan. Well, the problem is that they now need to get some changes to the SBA loan, and these people won't answer the phone. They don't budge, and it's a problem. And so we always encourage people to have like local banking relationships. We're big fans of community banks. And so I would encourage people to, build relationships, even if it's a small $10,000 loan, but have those relationships, because you never know when you're going to need them. And so maybe I'll leave it at that. I would encourage people to think about it and explore. And if people ever have any questions, I'm always happy to share direct insights, not on a live stream or something recorded and name names, but
exactly. Well, it's interesting. We a friend of mine, Kurt Anderson, works a fair amount with the manufacturing extension partnerships across the United States and some of the SBDCs and the economic development. And I tell you, there are a lot of government programs, there are a lot of state programs that can help you if you're going to do some sort of expansion or new business development. Like you said, every dollar helps, and some make a pretty significant difference.
Yes. And now that you say that, it just came to mind of lean into your vertical. So I was thinking about agriculture companies when you had mentioned SBDCs, but there are a lot of ag specific lenders and sources of capital. Yeah. So a friend of mine just started a new fund, a $50 million fund, and they're investing in companies that are ag related. and they're very good people. And not only that, but some of their investors are some of the top ag lenders in the nation, and they can just blow open the doors to all those relationships.
Yeah. Yeah. Good stuff. Cause I think that, the funding is important at the right time for entrepreneurs if they really want to scale. I'm kind of sad in some instances because a lot of the SaaS business or that industry sector, I mean, I don't even know if you can bootstrap anymore because everything is so, you got to get the funding to grow. Even when you've got profitable revenue, you just can't scale fast enough without additional investment unless you got deep pockets to start with.
Well, exactly, because a lot of those, what look like very profitable business models rely heavily upon, sales and marketing. And, what I'm hearing from people right now is I was just talking to somebody that was paying $10 a click on Google,
Yeah.
right? Like that's expensive fast, And so every business model has its challenges. Every business model needs to be capitalized. Microsoft has raised billions of dollars. I'm a big fan of Warren Buffett and Charlie Munger. May he rest in peace. Berkshire Hathaway. And even Berkshire Hathaway raises a lot of money.
Yeah.
Berkshire is sitting on over $100 billion in cash. And guess what? Every so often they do bond offerings and sell bonds for a couple $1 billion. Well, why would they do that? Because Warren is extremely smart. And he will go sell bonds in Berkshire and pay 1% to 2% on that because he knows the value of having a war chest in good times so he can, profit from the challenging times. So all businesses need to be properly capitalized.
Yep. That's a big deal.
Yep.
Well, Patrick, it's been awesome talking to you today. And I mean, just the stuff that you've been able to share about the magnetic vision of the owner and different kinds of investment, and talking about the way you guys are investing, or you can find investors like yourself where you're really trying to get your investment along the way, or investors that, if looking at it, that going to need an exit to get their return on their investment. Yep. Just so much good stuff there. And then about the vision and looking at the team in your business, and wow, it's just, thank you.
Yeah, well, thank you. It's fun to chat with you, and I know you are doing a huge service and working with people to understand how to get to an exit, and that's very, very important work, because a big reason why I wrote the book. But for the vast majority of entrepreneurs, their business is their most valuable asset, and as I mentioned in the book, depending on what you get at an exit, it's going to be the difference between being paid what you should have been paid in a real job and maybe making minimum wage for 20, 30 years. And so getting a big exit at the end of the day does matter because people's livelihood, families rely upon that, So
it just brings back again why we started the business the way we did, because it's like we won't just sell as is. If that's not where you need to be and you want to take it to a different level, we can help do that. And that,
exactly
like we were doing for investors, we do it now for private individuals and owners, because so many times if you don't pay attention to that valuation, you go, oh, I'd like to do it. And they kind of cursively go out and see what it's worth. They go, oh, you get that gulping feeling, and then you have to go back and put some different things into it. So
yes,
it's such a life-changing event. And that's what we say. It's either you come to the end with the money, knowing you've got the money you want out of that thing, or you come to the end with that life-changing decision.
Yes, very much so. And you can't overstate how important it is for entrepreneurs to think about this and think about it as early as possible, and to connect with experts like you. So
it takes a while to make the changes. That's for sure. That's for sure. Well, Patrick, thanks so much. Again, we have Patrick Donohue here from Hill Capital Corporation. They're in Minnesota. They're investing in great companies. It's so cool to see what you guys are doing, and really how you're taking these companies and really allowing them scale, like you said, from that couple million to 10 million. You're not looking for the unicorn multi-billion-dollar exit or anything like that, and really helping. These are real people you're able to help in the size of businesses that you're doing. And everybody's real, but you know what I mean? They're rolling up their sleeves and doing it. And that's awesome.
Exactly. That's why I get up every morning super excited to work with, Mercedes and Sergio and Pete and all the entrepreneurs in our portfolio companies and get to meet new entrepreneurs. So
Yeah. Yeah. Thanks so much. Well, again, thanks, Patrick, for being here today. Thanks everyone for listening. Nacer, thanks for saying hello. I didn't get you earlier, and thanks to everyone that was listening. If you didn't comment, hey, go back to the beginning. If you didn't hear this thing from the beginning and listen to Patrick, he's got a lot of great things about if you want to understand value, if you want to understand what investors are looking for and all that kind of things for entrepreneurs. Patrick, thanks so much. Hang out for a moment after we get off the air and we'll finish up.
that sounds good. Thank you, Damon.
You bet.